Be Wealthy and Smart, episode 1269.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about how interest rates have an indicator that flashed possible interest rate cuts are coming in the future. And wait till you hear what the Chicago Fed Bank president said about interest rates. It will shock you. But first, I want to note that we've been talking here on the podcast about interest rates coming down for some time. That's been our expectation, that we've been at the peak of interest rate hikes. I still believe that to be true. There's only a 14% chance that rates will go up in December, according to futures markets, and they're usually right, no matter what rhetoric the Fed is saying. And now recently, I'm just starting to catch wind of some experts coming out and saying, yes, indeed, we will have interest rate cuts, and they may be coming sooner than expected. One of the people talking about interest rate hikes is Guggenheim Investments, who is a Wall Street heavyweight. Their parent company, Guggenheim Partners, has about $218 billion in assets across fixed income, equity, and alternative strategies. What they're saying is that markets should gear up for the Federal Reserve to pivot and cut interest rates. Now, interest rates currently are at a 22-year high of 5.25% to 5.5%, and over the next several meetings, Guggenheim is saying they see a recession as likely in the first half of 2024. They believe if that happens, the Fed could quickly cut rates, ultimately cutting them by around 1.5% next year and more in 2025. They said, we have them taking the Fed funds rate down a bit below 3% and pausing balance sheet runoff in what we think will be a recession, albeit a mild one. In addition to Guggenheim, Wharton professor Jeremy Siegel also believes interest rates should be cut, and quickly. He said, the Federal Reserve needs to stay flexible and consider interest rate cuts a lot sooner than the market expects. That's because there's a threat of an imminent recession following weak economic data, and inflation has, for the most part, been tamed. Dr. Siegel said, I think Jay Powell has to be on high alert because we did get some weak data, certainly on the ISM, jobless claims, and certainly on Friday jobs report. The Fed cannot screw up the way it did on inflation by waiting a year too late. Now, I'm not saying we're going to have a recession, but he's got to be very alert to a slowdown. So the October ISM Manufacturing Index came in at 46.7 last week, which is well below what economists were predicting. They were estimating 49. And the latest reading also marked the 12th straight month below 50, which means manufacturing is in a contractive state. Meanwhile, the October jobs report showed 150,000 jobs were added to the economy, which was below estimates of 180,000, and unemployment ticked higher to 3.9% from 3.4%. Now, here's why that statistic in particular is really important, the unemployment jumping to 3.9% from 3.4%. Dr. Siegel explained, it's a reliable recessionary indicator that just flashed, and that happens when the unemployment rate jumps 50 basis points or 0.5% from its cycle low. That happened on Friday when the unemployment rate rose to 3.9%, up from its 3.4% cycle low reached in April. So that indicator has been pretty reliable to predict future recessions, and that's what Dr. Siegel is saying is going to happen if the Fed doesn't hurry up and cut interest rates. He says that has signaled many recessions in the future. I'm not there yet, but I just don't want a stubbornness on the part of the Fed the way they were on the inflation side. He ultimately expects the Fed's next interest rate move to be a cut rather than a hike, and it should come sometime in 2024. All right, now for the shocking part, because we're going to hear from a Federal Reserve Bank president what he has to say about interest rates. Austin Goolsbee, Chicago Fed Bank president, said yesterday The Federal Reserve has made significant inroads on bringing inflation back down to its 2% target, and if that continues, attention will turn to how long to keep interest rates at current levels. Over the next couple of months, we might equal the fastest drop in inflation in the last century, Goolsbee said in an interview on CNBC. Let me repeat that. This is the Chicago Fed Bank president. This is not a Wall Street forecaster. This is not a podcaster. This is not anyone of insignificance in the Fed's world. This is a Chicago Fed Bank president. Austin Goolsbee said, quote, "Over the next couple of months, we might equal the fastest drop in inflation in the last century." So we're making progress on the inflation rate. And as long as we're making progress, as I've been saying for a while, he said, the moment of arguing how high should the rate go is going to fade to how long should we keep rates at this level as inflation is coming down. And that's exactly right. Inflation has been trending down, unemployment's trending up. These are two important metrics that the Fed uses as tools to determine which way inflation is going and if the economy is slowing, and it definitely is showing signs of that. So I think he's aware of this indicator that when the jobless rate jumps by 0.5%, it is a future indicator of a recession. He knows that that's what's on the horizon, and he's saying you could see interest rates come down really, really fast, because if inflation is coming down quickly and it looks like the economy is slowing as much as that indicator might be telling us, the Fed is going to get on it and start to drop interest rates. And usually when they do reduce interest rates, after raising them very quickly, they generally do lower them very quickly. It's not a slow, gradual pace. If you look at past history, generally the interest rates have come down very, very quickly, because this is what happens. The Fed overdoes it, they cause a recession, and then they panic and they reduce rates quickly. And that's why I'm predicting that we are still going to have a strong housing market and a big housing boom as rates go lower than people anticipate. I'll keep watching that and reporting to you what's going on with rates, but don't be surprised if we don't start hearing about interest rate decreases instead of increases pretty soon. If you haven't yet subscribed to Be Wealthy and Smart, hit the subscribe button and you'll be notified of new podcasts as soon as they become available. And all of my podcasts are on my website at lindapjones.com/podcasts. And while you're there, sign up for my weekly newsletter for more wealth tips. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.